Okay, great. Well, good afternoon. It is great to be here. I'm a proud alum of Harvard University. I have worn the Harvard tie specifically for this occasion. I break it out once a year, and it is great to be back on campus on a very gorgeous day. So thanks for having me, and look forward to covering a bunch of things regarding hedge funds in general, some details, and also some life lessons learned. And I guarantee you there'll be something here you didn't know before, and I've gotten emails and letters from people years later that something was $1 million idea, either made them $1 million or saved them $1 million. So I promise this is going to be worth the price of admission, and we will definitely take questions at the end. But seriously, we get emails from people years later after getting their first or second job saying that something I said 5 or 10 years ago changed their life in a good way. So hopefully the same happens here. Here's all my contact information, but we'll be getting copies of the slides distributed, so no need to type everything down. There's also a QR code at the end. But as you can see, I'm Evan Katz, Managing Director, Benoni Capital, based in Midtown Manhattan, New York. And again, great to be back at Harvard and back on campus. The Wi-Fi has gotten a lot better since when I was here. When I was here, there was no Wi-Fi. Quick general background, native Long Islander, as it were. Went to Wharton, was a finance major there. Went to Harvard Law School, actually same class as Michelle Obama, of all crazy things, and a bunch of other people, but including Michelle. Have spent 20 years in hedge funds and on Wall Street. Was director of the Hedge Fund Association for about 5 or 6 years. Have been nominated as the best fundraiser in the industry. And again, it's great to be back at Harvard. So the state of the hedge fund industry, it's surpassed about $5 trillion. After taking a bit of a dip a couple of years ago. Took a bit of a dip a couple of years ago when there was a lot of quantitative easing and the Fed was putting a lot of money into the markets, and anyone could throw darts at any stock on Wall Street and make a lot of money because quantitative easing was going on and interest rates were low. And then people remembered the stock market does not always go like this, and hedge funds tend to not always make pretty good returns. Typically by having some downside protection if they're done right. And today we'll sort of get into the nitty-gritty of what hedge funds do, because there's a lot of different flavors. Probably not 31 like Baskin Robbins, but there's a lot of different flavors of hedge funds, and we'll get into that. So, one of the things I often say is be careful of the most hot and trendy strategies. I started saying a couple of years ago that private credit was getting a little bit frothy, that too many people were going in and the irrational exuberance was getting a bit great for private credit. And sure enough, now that's beginning to play out. There's an old expression that when the man or woman who cuts your hair starts asking about stock tips or discussing the latest trends in investing, you know that something is probably a blip. And sure enough, now everybody's waking up 2 years later that maybe too much money got put into private credit and too much good money chasing decreasingly good ideas. So additionally for the state of the hedge fund industry, one thing I always mention is something about smaller managers. I get this question a lot, so-called emerging managers, or everybody who graduates Harvard or Wharton wants to start their own hedge fund. The interesting thing about emerging managers is they actually tend to outperform. Smaller managers tend to actually make a couple 100 basis points a year more than some of the big ones. Obviously, there's exceptions in both ways. There are some great big funds and some horrible small funds. But a lot of folks tend to not invest in emerging managers, even though they tend to outperform. And people say, well, why is that? If they tend to outperform, why don't they? And as said on the slide, there's an old expression, ask your parents, no one ever got fired for buying IBM. Same thing here. No one ever got fired for buying any of the major hedge funds. And if they have a bad year, blame the hedge fund manager, but no one ever got fired for investing in the name brands. But if you invest in an emerging manager and they have a bad year, God forbid, you might get blamed instead of the manager. I'll skip over in the interest of time some of the regulatory stuff. It'll be in the PowerPoint slides, but it's late in the afternoon. So what is a hedge fund? Who started the first hedge fund and in what year did he do so? Does anybody know who started the first hedge fund? Don't be shy. Anybody. Going once, going twice. Okay. The first hedge fund is widely credited to have been founded by Alfred Winslow Jones, affectionately known as A.W. Jones, and it's a little bit more than 75 years ago. And, before him, everybody just tried to figure out which was the best stocks to buy and did all the fundamental analysis and the discounted cash flows and everything else. And that's how you invest in the stock market. You tried to pick the best stocks to buy and the best horses to run. And then A.W. Jones said, well, what if we could also try to figure out which companies are overvalued or might have problems, and we can short those stocks? And he created the first quintessential long-short fund where you were going long a bunch of stocks you thought were going to go up, and you were shorting a bunch of stocks you thought were going to go down. And when you think about it, given the correlations to the S&P and the correlations to the stock indices, if you have some long exposure that tend to goes up when the markets go up, and you have some short exposure when the markets tend to go down, you can maybe make money in either or both directions, and the overall portfolio is going to be less because your shorts tend to go down when the market goes up and up when the market goes down. And that was a little bit more than 75 years ago. And the notion was to make money no matter which way the market went, or at least not to lose so much money when the market had a downturn. I'll just quickly tick off a couple of different strategies. Hedge funds typically used to be just long short. It's still the number one most popular one. There's also activist hedge funds where hedge fund managers try to get involved with companies that could be managed better or have a lot of bad management in place. The CFO who's been there 50 years and is horrible. The family company that hasn't really learned how to manage the company. Activist hedge funds. A lot of people now have algorithmic, quantitative, and systematic hedge funds, where basically you're making rules-based things, programming them into a computer, and hopefully it does better than humans alone. There's fixed income, global macro hedge funds. Instead of picking stocks, look at global trends, what's going on in the world, interest rates in this country, currency rates in that country, and try to trade accordingly. And there's several other strategies, and again, the slides are being handed out. Nowadays, there's a lot going on in hedge funds. There's artificial intelligence, which obviously has been a huge emergence over the last couple of years. I say my best friend now is ChatGPT, and when I can legally marry it, I probably will. I have been using it nonstop for virtually everything. I think I used to Google dozens of times a day or a week, almost never anymore. So artificial intelligence has been a huge boom in the markets and in hedge funds, trying to find better data, understand things better, and so forth. But obviously, it's not perfect. It's usually right 90% of the time and close to right 5% of the time, and 5% of the time it's completely off. So obviously, trust but verify. Commodities, hedge funds, oil, gas, gold, silver, corn, wheat, cryptocurrency hedge funds, which have been probably the biggest roller coaster of all, although they can provide some phenomenal returns because it's a very inefficient market. A lot of people running crypto funds, at least used to be, kids off the street who never ran a fund in their life and think they're going to be the next great crypto trader. And a lot of times, if the professional hedge funds were up against them, they were eating their lunch. So a lot of crypto hedge funds did extremely well. Some did not. And that market is now becoming a bit more efficient because everybody's getting into cryptocurrency these days. 10 years ago, Goldman Sachs and Morgan Stanley did not know what cryptocurrency was. 5 years ago, Goldman, Morgan, or BAML wouldn't touch cryptocurrency. And now most of those institutions are letting their advisors put their clients into cryptocurrency funds. So welcome to the new world. Intellectual property patents and licensing I've seen done in hedge funds, life settlement funds where they buy life insurance policies. And yes, you got it. They basically are making money when people die. There's life settlement hedge funds, litigation finance, mortgages. I mean, at this point, pretty much anything can be a hedge fund except long only picking stocks, pretty much anything. If you can find me, I've often said, if you can find me the man or woman who can pick the horses at the racetrack and we can get that track record audited, I will form a hedge fund around that man or woman who can pick the horses at the racetrack. Decades later, I'm still waiting for that phone call, have not gotten it yet. But if you can find me that person, let me know. There was, by the way, a legal hedge fund operating out of Las Vegas where they have legal sports betting that actually did have a hedge fund that did sports betting. And if you can pick the team 60% of the time who wins, there's a great hedge fund. So the typical hedge fund, again, typically is trading liquid instruments, stocks, bonds, typically on a stock market. not a mutual fund. As you may or may not know, most hedge funds charge a 1 or 2 or 1.5% management fee and a 20% performance fee. So some people complain that the fees in hedge funds are high, and well, that's true. But there's two ways of looking at the world. One is how much am I paying for something, and the other thing is what am I getting. So if it's a great hedge fund that produces great returns, people will pay more for a Lamborghini than a Honda. If it's not, then you're overpaying on fees. So, but that's I think that's the story for pretty much everything. Rarely do hedge funds have a hurdle rate. A lot of private equity, real estate, and venture funds only get a piece of the performance over 4, 5, 6, 8%. Somebody asked me, well, how come hedge funds don't also have a hurdle rate where the manager only gets 10, 15, 20% after hitting some benchmark? There's really no reason for it. It's just tradition. Traditionally, hedge funds haven't. It's strictly been sort of typically 2 and 20. They typically take subscriptions monthly, meaning new investments monthly, and redemptions are typically quarterly, but not always. Here's the one hedge fund cartoon for Harvard University today. Greenwich, as you may or may not know, was sort of the unofficial capital of the hedge fund business. I won't ask people why. There was a good reason why. The great state of Connecticut used to not have a personal income tax. So if you ran a hedge fund and if you were successful, God willing, and you made a lot of money, and you lived in Connecticut, you paid no state income tax. Or if you lived in New York, between city and state, you paid income tax. That actually changed recently, but having everyone been in Connecticut has remained that way. Now, as I mentioned, hedge fund fees have come down a little bit. There's more competition. These days, markets are a bit more efficient. And in the big bull market where everything was going up at a 45-degree angle, hedge funds, some people say underperformed, and I'll put that in air quotes because they're designed to hedge during a market cycle. Not everybody goes up every month except Bernie Madoff, and I haven't spoken to him lately. I'm not sure what he's doing. So, but fees did come down. So I was speaking to at a big conference once, a big investor hedge fund conference, and I said, I really should take the slide and change it from 2 and 20 to 1.5 and 20 or 1.5 and 15. Just haven't gotten around to it because the fees have really come down to some degree. And then someone actually sent this in to me the next day from the audience. Actually did a gorgeous PowerPoint Photoshop job and matched the font and everything. So probably 1.5 and 15 are pretty much the new hedge fund fees. So how are hedge funds structured? What types of entities are they, and how and where they are created? I'm going to take 20 years of hedge fund experience and condense it into 60 minutes, more or less, of what remains. So there's actually 3 entities for hedge funds. There's the hedge fund itself, ABC hedge fund, and then there's the investment manager that manages the hedge fund, and the general partner that is the general partner of the hedge fund. And they're typically all Delaware, because Delaware is as you probably know, the corporate capital of America. It is, I wouldn't say business friendly, but somewhat business friendly, business savvy anyway. So if you ever form a hedge fund, it should be Delaware. It doesn't matter if you live in California, Arkansas, Florida, doesn't matter. Every investor knows Delaware. Keep it simple, stick to Delaware. So there's the hedge fund itself. The investment manager advises the hedge fund, and then the general partner is the general partner in the hedge fund. Why is there a separate investment manager and a general partner? Great question. Long story short, taxes. It used to be that a lot of hedge funds had long-term capital gains, and to make sure that the hedge fund managers got the lower tax rate, they have a separate manager and a general partner. I'll leave it at that. If there's any tax wonks in the audience, you can Google and look up on ChatGPT about taxes, long-term capital gains, and why there are 2 entities instead of just one. There's also offshore. Typically, almost every hedge fund has an offshore entity, typically Cayman. Although if you want to impress anybody in the industry, it's actually pronounced Cayman down there, but no one ever says it. Everyone says Cayman. Could be Bermuda, could be British Virgin Islands, could be Ireland, could be Luxembourg, but it's typically Cayman because basically it's the Delaware of hedge funds on the offshore version. So, when I first started in the industry 20 years ago, why do you need an offshore entity? Gets back to taxes. basically for non-US taxable entities. So in the US, endowments, foundations, pensions, 401ks. If anybody works at the Harvard endowment down the block, or actually a few blocks down the block, and wants to wire us a couple of $100 million today before they take off, feel free to do so. The Harvard endowment, what is it now? It's like $40 billion or something like that. And it does not pay taxes. But in order for it not to pay taxes, it needs a so-called blocker. Hence, you need the Cayman Island Fund to have its tax blocker. Again, if you're ever having any trouble sleeping one night, start Googling Cayman Island blocker hedge fund, and you will learn why we need a Cayman blocker. But it's basically for the tax exempt, so they don't get taxed. Same thing with the European, Asian, Latin America investors too. If they invest in the US, there could be tax and withholding, so they invest in Cayman. It's a beautiful place. It's a bizarre place. Half the island works in financial services. It's very strange. I mean, half the people there work in hedge funds and private equity, and there are lawyers who do the same. Very strange place. And then also you can have SMAs, separately managed accounts, where instead of investing in the hedge fund itself, you basically have your own account. The hedge fund manager manages it. The economics can be the same, and you have a little bit more visibility into it. People thought after Madoff it was going to be the panacea because you can't commit fraud in an SMA because the investor sees where the money is and knows what's going on. But some investors do SMAs, some don't. One thing I should mention in terms of the hedge fund ecosystem, real briefly, who are the service providers? Because you have the entity, you have the general partner, you have the investment manager, but who else is involved in the world of hedge funds? I'll be quick with this because it's service providers, but just so people have some idea, there are accountants and the auditors. I mentioned some of the big ones here. They audit the hedge fund and make sure that the numbers are legit. There's a so-called administrator. Every hedge fund is now administered by a third party. Fun fact, Bernie Madoff self-administered. So Bernie Madoff told his investors how much money he was making them every month. What could possibly go wrong? Nowadays, nobody will invest in a hedge fund that is self-administered. So if I'm running a hedge fund, I do not tell everybody here what my returns are, my performance is. Our independent administrator does. Obviously, there could be nothing getting done without attorneys. I mentioned some of the attorneys here. Banks, compliance consultants, yes, cybersecurity. The SEC actually now audits hedge funds or reviews hedge funds, not only with regard to their investments and a bunch of other things, but also their cybersecurity, because just like fraud or bad investing could cause investors to lose money, so could the hedge fund being hacked. So welcome to the brave new world. Insurance and prime brokers who help the hedge funds with the trading. You can certainly look up what these people do offline. A couple of things about who works at hedge funds and what each person does. Obviously, there's the hedge fund portfolio manager, or so-called PM, who's supported by a team of analysts. Now, of course, there's a bunch of quants who do coding and models and pivot tables and Excel. If anyone is a real Excel geek, by the way, look it up on Planet Money, the podcast on NPR. There's a great episode about the Excel Championship. There is actually an annual worldwide Excel Championship where people compete. I don't know if they trash talk, but it's pretty intense. It's a Planet Money episode on NPR about the best Excel geeks. And the joke is that they can do it quicker without a mouse, just knowing the keyboard shortcuts. But those are the quants. Obviously, a chief financial officer, accountants, chief risk officer, and general counsel. But you can have a hedge fund running a couple of $1 billion with probably a dozen people. What documents does one need to run a hedge fund? What are the principal documents? Basically, these 5 or 6. The so-called one-pager, the tear sheet. I kind of call it the baseball card for hedge funds. If you have a baseball card or your favorite player, soccer player, football player, all the statistics, the performance, the metrics, the Sharpe, the Sortino, a little bit about the manager's bio, who the service providers are, the one-pager. The PowerPoint's pretty self-explanatory, the 10, 15, 20-page, please no longer, 10, 15, 20-page slide deck about the team, the investment strategy, and so forth. The private placement memorandum is the legal document. This can be 50, 80, 100 pages. It is basically the disclosure document covering everything in excruciating detail, every risk factor, And kind of like a prospectus when a company goes public, it often focuses on everything that could possibly go wrong. So if anything goes wrong, no one says, we didn't tell you. Subscription documents, how you basically subscribe and invest in the fund. There's also an investment management agreement and a virtual data room where you can go online if you're a potential investor and go through all the hedge fund's documents and so forth. What types of entities typically invest in hedge funds? The most common, well, I already mentioned endowments, Harvard's endowment, Yale, all the big schools and so forth. So we'll start off with the U.S., I guess. U.S. taxable, mom, pop, family offices, high net worth families. Actually, technically, you have to be an accredited investor to invest in hedge funds. So family offices can, but mom and pop probably cannot. It's interesting, from many different perspectives, how the law basically assumes that if you make a certain amount of money, you're smart enough to invest in hedge funds. So, you could be, I won't pick on anybody by name, but you could be a multi-millionaire social influencer or TV reality show star, and maybe you are one of the brightest people around. I once was a lawyer, met Cindy Crawford. She's brilliant. The model, she's brilliant. But the interesting thing is that you could be a multimillionaire reality show star and you can invest in hedge funds because they think you know what you're doing financially. So not necessarily the case. Who knows? High net worth families, family offices, investor clubs. Tiger 21 is one of the bigger ones. But like I said, basically on the institutional side, the Harvard Endowment probably has well over $1 billion invested in hedge funds, foundations, charitable, the Ford Foundation, the Gates Foundation, all the big charitable foundations invest in hedge funds. So-called fund of funds invest in hedge funds. Outsourced chief investment officers, pensions. I was once riding the subway with Congressman Jerry Nadler from New York, and he's like, "Evan, you're in the hedge fund business, right?" I said, "Yeah." He's like, "What is a hedge fund?" We started talking on the subway on the number 1 train about what hedge funds were. And he said, "But you've got to be really rich to invest in hedge funds, right?" I said, "Well, sort of." I said, "You do, but one of the things that most people don't realize is that teachers and firemen and policemen and policewomen and firewomen, and they have billions of dollars invested in hedge funds." And he said, "Well, that's impossible. They're not most of them accredited investors. How could they be invested in hedge funds?" And I said, "Don't forget, their pensions. So the teachers' pensions, the firemen, firewomen's pensions." They all have billions of dollars invested in hedge funds. So indirectly, what I say when I go to work every day is, yes, we are making a lot of rich people richer, but we're also helping Harvard keep tuition down and give free tuition if mom and dad, or mom and mom, or dad and dad make less than whatever a certain amount is. So similarly, we're also helping teachers retire and firemen retire as well. So it's interesting business. Who regulates hedge funds? So this is an interesting one. It took me a long time after I got into the industry to really figure this one out. Basically, we have a fragmented system. In Britain, it's the FCA, the Financial Conduct Authority. And as I like to say, if in the UK you do anything with money, the FCA regulates you. If you deal with finance, they regulate your conduct. In the US, it's kind of a weird situation. We are sort of bifurcated. We have the US Securities Exchange Commission, which everybody knows. And we have the Commodity Futures Trading Commission, or the CFTC, which most people don't know unless you work at a hedge fund or come from Chicago, where they deal with a lot of commodities. So it depends on what you trade. If we form a hedge fund today, tomorrow, and we trade securities, we're regulated by the SEC, the Securities and Exchange Commission. If we form a hedge fund and we trade commodity futures, we're regulated by the CFTC. But the crazy thing is if we form a hedge fund and we're trading something more esoteric, like I say in the slide, rare baseball cards, rare wine, I'm not joking, we've had people pitch us on those type of things as well, there's no regulator, because there's no regulator for rare baseball cards or rare wine. Now, I mentioned at the end of the slide, the CFTC has anti-fraud jurisdiction, but it's a strange situation where if you do something kind of bizarre, there's no regulator. One thing I also mentioned is something about hedge fund blowups, the Debbie Downer Award. 20 years in the industry, got to have one slide about hedge fund blowups because they do happen. The interesting thing about hedge fund blowups is, I've been doing this for 20 years. I've never seen a situation where a hedge fund manager, he or she had, say, 26 positions, A through Z, and he or she got most of them really badly wrong. I don't mean a little bit where they lose some money. I mean really badly wrong. It's never that. It's always the same stupid, dumb things that nobody over a certain age should do, but people do it. So basically, it's one of two things. Being concentrated in too few positions and having too much of your money, too many of your eggs in one basket, or two, having too much leverage where you're borrowing money to invest more. And obviously, if you borrow money to invest more and you're profitable, you're multiplying your profits. But if you borrow money, which is fine, to invest more and you lose money, you doubled your losses. So, back in 2007, I'm not sure where you guys were in 2007, but if you went to Wall Street and you essentially bet that Lehman Brothers and Bear Stearns would be out of business within a couple of years by buying deep out of the money puts or credit default swaps or whatever, well, the first thing is if you were saying Lehman Brothers and Bear Stearns would be out of business, you'd first be locked up for being certifiably insane because you were. It's Lehman Brothers and Bear Stearns. Not in a million years could they go out of business. That's like saying Goldman Sachs or Morgan Stanley would go out of business. The crazy thing is they did. But Bear Stearns and Lehman Brothers did not go out of business because they got a lot of things wrong. Nope. They were over-levered and over-concentrated. And if you're over-levered, in this case in subprime mortgages, and over-levered, it's a recipe for disaster. I always say it's like driving a motorcycle on the Mass Pike. If you're going 30 or 40 miles an hour on a motorcycle on the Mass Pike and there's a pothole, you can go over most potholes at 30 or 40 miles an hour, or you can go around the pothole at 30 or 40 miles an hour. You're going 50 or 60, some potholes are going to blow out your tire or you can't get around them. Well, when you're levered massively and over-concentrated, that's like driving 150 on the Mass Pike. One thing goes wrong and you're toast. And the crazy thing is, I don't know if anyone's ever read When Genius Failed. Great book. It's a great book about long-term capital management. Nobel Prize winners who had all the correlations mapped out to a science, and they had all the correlations mapped out, and they were running these incredibly complex, sophisticated hedge fund portfolios. But the problem was they were levered about 20 to 25 to 1. So for every dollar of equity they had, they were borrowing 20 some dollars. So if you're profitable, that's great. If you're profitable a little bit, that's still great. But if you're down a couple of percent and you're levered 20 to 1, do the math. You're out of business. So it's a great book, When Genius Failed. And, a basic lesson that any, person learns at some age, don't put all your eggs in one basket. And certainly someone who's working on Wall Street, never should make. Same thing. I always have another Debbie Downer slide about hedge fund frauds. It's kind of similar to the Blowups. Basically, I always say that, the number of hedge fund frauds that resemble Tom Cruise in Mission Impossible with heavily sophisticated, Bernie Madoff-like frauds, they're very few and far between. Most of the hedge fund frauds were just incredibly simple, but no one checked. So Bernie Madoff, $65 billion Ponzi scheme, the greatest fraud of all time, he was self-administering. Well, everybody knows you should never invest in a hedge fund that self-administers. No one would ever do that except it was Bernie Madoff, and he used to be the head of NASDAQ, and people cut corners and basically didn't follow the informal or formal rules. And what could possibly go wrong? Well, $65 billion Ponzi scheme is what went wrong. Another one was Pedders, only, in air quotes, only a $3.65 billion Ponzi scheme, where it was a hedge fund that was basically factoring based on orders that companies had. Very simple. You've got a $10 million payment coming in. The hedge fund gives you $5 million. Everything's fine. What could possibly go wrong? Problem was all or some, I forget which it was, but let's say at least some of the orders were made up. They didn't exist. Well, it's very simple. Before Harvard, Yale, or Teachers Endowment puts a couple $100 million into a hedge fund, you check. You check with third parties. And a bunch of investors said, yeah, give us the names of some of the companies or the lawyers who you're doing these deals with as part of due diligence. And Pedders basically said, well, that's confidential. trade secrets, and some investors said, no thanks, goodbye, and walked away. But many investors, $3.65 billion of investors invested. And obviously they never should have, because whether the names are confidential, there's no reason in the world why a hedge fund manager can't say to investors, here's the name of our law firm, big law firm. They can't tell you the names of the borrowers, but they can verify that what we're saying is true. In other words, there's ways that you can negotiate these things, but in this case, none of that was provided. Almost $4 billion was lost. Same thing with Rothstein, $1.2 billion. Fake legal settlements, litigation legal settlements, same thing. They wouldn't give out the names of the cases because it was confidential. Half of them or most of them were made up, and a lot of investors walked away, but 1.3 didn't. So basically, very simply I say on the slide here, most frauds are very simple. You check with third parties, and that'll prevent most, if not all, frauds, almost all. One question we get, especially from MBA students and undergrads, is how to get a job in hedge funds. So if anybody here at Harvard today does get a great job in hedge funds because of anything you're about to see, I will give you my Venmo. Anything will be taken, 10%, 20% of the first couple of years' salary, laptop, whatever, that would be great. Please, I'll send you the Venmo later. So this slide is actually worth the price of admission in the next couple of months too. I know people who've gotten jobs from this. So I say up top, LinkedIn and recruiters are when you have some experience. There are hundreds of hedge fund jobs on LinkedIn, and there's hundreds of hedge fund recruiters. And I'm not exaggerating, hundreds of both. They typically want someone who's got experience. Alborn Village has hedge fund jobs. LinkedIn has hedge fund jobs, recruiters. I gave about a half dozen names of some of the top hedge fund recruiters. Keep the slide somewhere in a couple of years. If you got some experience, you can go back and take a look. Pro tip with the exclamation point. If you're ever looking for a job in hedge funds, do an advanced search on Google. Some people don't know you can do this. For people who work in hedge funds and who went to your college, university, in this case, Harvard, most people get an email from somebody they went to their school, and they typically will reply. Another pro tip, if you don't hear back, these people are working 60, 70, 80 hours a week. Do not take it personally. Follow up in 2 weeks, not in 2 hours, not in 2 days. Follow up in 2 weeks. I've often said most people will help you out. People are busy, people are swamped, but most people will help out. There's also a slew of hedge fund trade organizations. I gave a list of another half dozen of these, the alphabet soup at the bottom. They all have meetings. They all have committees. Get involved. If you're in a city or location where there isn't one, form one. That is probably one of the things that people have asked you, like, what was it like at Harvard Law School? I said teachers were amazing, professors were great, the classes were incredible. They said, well, what were the people like? So they were just normal people. They were smart people, of course, and hardworking. But the one thing I noticed at Harvard Law School, and I know the same goes for the undergrad, is a lot of them started something. It wasn't just Bill Susie who was the editor of the school paper. It was Bill Susie who started a new publication. Or it wasn't just Bill Susie who was CEO or executive director of some interesting charity. It was someone who started their own. So great organizations, get out there, go to the meetings. Hedge funds is a very networky, social, after hours drinking industry. Definitely join some of these organizations. And if there's not one near you, maybe form one. The next slide, also, I've gotten emails from people where instead of helping them just get the $1 million job, it's helped them from losing the $1 million job. Same Venmo rules apply, feel free. So the first tip here, and I mean this quite sincerely, obviously, do quality work. That's a given. No one needs to be told that. Second one, try to see what else you can do around the firm or the shop, whatever the job is. That maybe you weren't assigned, but maybe it needs to be done also. Third point, I was not focused on this enough when I graduated. Can you be a revenue generator? I mean, whatever your career is, marketing, law, hedge funds, whatever it is, can you be a marketing generator and a business generator and a new client generator? Because if you help bring in the business, that's the best job security you could ever have in this world, is you're the man or woman who's bringing in a lot of the business. Pretty much anything goes. You've got that job for obvious reasons. The fourth point, is actually taken from my experience, both as a lawyer and also 20 years on Wall Street, and also based on my wife's experience. She's an executive director at a global Fortune 100 global investment bank that you know, massive, massive place. Always do the annoying part of the job, and I say annoying in quotes, but there's always some annoying part of the job. Expense reports, timesheets if you're a lawyer, budget reconciliations. Don't be the person who doesn't get the annoying part of the job in on time. I mean, once in a while everybody's late, but if it's once in a while and you're going to be late, tell somebody in advance and just get it done. But don't be the person who every month is late with the expense reports, the timesheets, because you don't want to be that person where, if it is layoffs or reductions in force or something like that, put yourself in their shoes, whoever's doing the layoffs. You don't want to be the person who's at the, the PIA, in the PIA column. As I like to say, at the last point, don't be your boss's dinner table conversation, where, your boss is talking to their significant other or spouse, and you're the one they're always complaining about because you're always late getting this done or that done. Don't be that person. I've often joked that basically all bonuses, promotions, and other decisions like that could be done by the spouse or significant other of someone's boss, basically by who's the person they never hear about. Or I guess the one they hear great things about gets the biggest bonus. The one that they don't hear about gets a good bonus, and the one they hear about all the time because they're a pain in the you-know-what doesn't work out well. Couple of other critical life lessons, and I'll take some more questions. We had a couple sent in advance, but think of any good hedge fund questions you'd like. A couple of good life lessons. This is another one of those Venmo moments where people have emailed me years later, this saved my you-know-what. The first bullet point, this has been one. I know people have actually made a ton of money on this one. If you go to a networking event where people are, they're networking. First of all, always have business cards. I actually have them. And people may say, dude, you're a dinosaur. Business cards are from 100 years ago. Nobody uses business cards anymore. There's apps and there's swipes and the whole thing. Why do I need business cards? Great question. Basically, the answer is if you're at a networking event, most other people have them, though after COVID, it's pretty 50-50. Number one, you've got a card, you can give it out. Number two, and it says in the bullet point, take notes on business cards. And no one does this. People go to a networking event with, 200 people, they meet 50 people. Unless you're the weird person who can memorize the phone book and remember pi to 10,000 digits, none of which I can do, you're not going to remember who that person was who's the one who works at the hedge fund versus the marketing firm versus the private equity firm versus the venture capital firm, and who's the one who might have the job lead or the investor lead or that knew my cousin and grew up with them or whatever. Just take a few notes on the back or on the front and I have a little star system and a couple of abbreviations. People have emailed me years later. It's essential. The other thing about if you don't have a card, put a bag of card, a case of cards in every handbag, jacket pocket, whatever. So what's wrong with the bump and the swipe and the iPhone and the whole thing? Because if someone doesn't have a card, what do I do with them? Well, I'll do the swipe and the iPhone and the whole thing, but then there's the trick. Unless somebody figures it out, and no one's ever done it, the next day, how are you going to remember who that person you met was? In other words, their contact information's in your phone. My contact list has, I'm not joking, over 100,000 people from the hedge fund and venture capital and private equity and alternative investment industry. By the way, more than half of them are allocators. So out of the over 100,000 contacts, at this point, more than half of them are endowments, foundations with several $1 trillion of capital. Okay, but I just saved your or his or her contact information on my phone the next day. I don't think there's any app. Please email me if you know of one that will say, find me my contacts that were added within the past week or 24 hours. Like Mac or PC has a way of saying, show me my files that are recent and all this stuff. So the trick is, and here's the $1 million piece of advice, if someone doesn't have a card and you swipe and do the scanning and the virtual thing and the whole bit, take a screenshot of everyone you did that with. So the next day you can look in your photos, and that has saved my kosher bacon a lot. Same thing if someone doesn't have one of those things, ask their permission. Can you take a picture? of their name tag. No one's ever said no, but it's a little bit stalkery to go up to someone, and take a picture of their name tag. Just say, and everyone's like, of course, yeah, of course you can. So take notes on business cards, always have them in every pocket, no excuse for running out. Make notes and then follow up. This is insane. I'm not sure if one can quote Woody Allen anymore for reasons you may or may not know. He had an expression, 90% is just showing up. So you go to the event, you sign up for the event, maybe it's free, maybe you pay. You go there, you network, you talk to people, you take notes on business cards. If they don't have one, you swipe, you bump, you do the whole thing. And then the next day, most people get too busy at work and they don't follow up. And I'm absolutely serious. Well, why bother showing up? And don't get me wrong, I'm swamped, I'm busy. I always say to my wife, I'm swamped, but you've got to make time. So I always say to people, if you're going to a big industry conference on a Monday or Tuesday night, and they're typically after work, hence the cocktails, but not always. But if you are, block off time on your calendar for the next morning or the next sometime, an hour to go through the cards and the phone and the swipe and the screenshots to follow up. And the reason why I know that most people don't follow up is there are times, one of these events, I meet somebody, we can do business together. They're a great hedge or venture fund. I know 1,000 endowments, foundations, and other investors. We can make a match. It's good for everybody. It's a win-win-win. There are times when investors, endowments, foundations are saying to me, Evan, I'm looking for this type of fund. Do you know anyone? So the opposite, the converse. Yes, another win-win-win. But there's occasionally times where I can only help them. Where basically it's one way. They're looking for a job or something. Do you know somebody at a certain firm? And it's a one-way street. And 80% of the time, they never follow up. So follow up. I'll say a couple of other things and we'll wrap and take questions. Number 3 has saved people millions of dollars, no joke. If you start a company and God willing it's successful, you make a fortune, sell some of your stock. Because when I was younger, I helped start a company. We took it public on NASDAQ. I never thought, wait a minute, oh my God, I've got 99% of my money in one stock. Like you would never go to your broker now and take 99% of your money and put it in one stock. But if you start a company and it goes public or it's sold, you're in the same boat. Don't keep 99% of your assets in one stock. Sell half. If it goes great, you'd be like, oh, well, I could have made more. And if it doesn't go great, you'll thank me years later. The last point, for what it's worth, another piece of advice, enjoy Boston, New York City. Don't get too caught up in the scene for too long. Life can pass you by quickly. Not saying I did, but just there you go. This is the QR code. It's going to be in the slide deck, or you can take a picture on the screen. Please email me next week. If you don't hear back, give it a couple of weeks. I've said before, even with investors, I've been doing fundraising for 20 years. And a lot of people new to the business say, I emailed the endowment, the foundation about ABC Hedge Fund or XYZ Venture Capital Fund. I never heard back. They must not be interested. And to coin a phrase, I said to people, fundraising is not dating. If he or she does not get back to you about a date or coffee or whatever 3 times, they're probably not interested. People are busy, so give me 2 weeks, but I try to get back to everybody. We did get a couple of questions in advance. I'll take 1 or 2 more. I'm not going to read it, but you can read the first question. The democratization of private markets to 401k investors. It is probably one of the most interesting things going on, where now there is a huge demand for salespeople and fundraisers who know a lot of the RIAs, the investment advisors, to bring them hedge funds and private equity funds. I've been doing this for 20 years, and out of the 1,000 allocators that I know and have relationships with, some better than others, of course, it's a lot of the Harvards, the teachers, the Yales, the firemen, the policewomen, the usual suspects. But there are, probably well over, $1 trillion or more that are in local brokerage firms and mid-sized brokerage firms and investment advisors. So there is definitely an increased demand for people who know some of those communities and can help raise assets from them, because there's not a lot of people who know a lot of them. Second question, the Iran war, and I'll throw in there the tariff situation. No, it's been bonkers. There is one thing, at least one thing that business people like about business and investing. It's stability. It's the rule of law in most developed countries. It's the rule of law that there's contracts and contracts will be enforced. And it's been a bonkers year, with the Iran war and also with, tariffs and other things. It's been a bit of a bonkers year, and it is very hard. It's very hard to do fundamental investing, whether it's long, short equity or global macro or what have you, when there's a lot of exogenous things that can be going on. So, there's not a heck of a lot of way to prepare for that. Interestingly, I am sure there were some extremely bright people who thought this was going to happen and went long on oil. Guaranteed there were some really smart people when this comes to light. No inside information, but just that we're reading the tea leaves and looking around the corners a little bit better than people. It's like, the great subprime crisis. 90% of people thought, what could possibly go wrong with subprime mortgages? Everybody was doing it. And, your mom and dad says, well, just because your friends jump off the Empire State Building, don't jump off the Empire State Building. Everybody was doing subprime, but there were a few people. Greenlight, I think, was short subprime. If anyone's ever read the book or seen the movie, The Big Short, definitely great book. Also great movie. Steve Eisenman. Actually, I went to college at Wharton and law school with Steve Eisenman. He's featured in the movie. I think Steve Carell plays him. He was one of the ones who was one of the people who said, this doesn't seem to make sense. Everybody's investing in subprime. Your barber's investing in subprime. Every person you meet is talking about it. So there are some people who could see around corners better than others. I'm sure some people did make a killing in oil by seeing around the corner better than others. But it is very hard to be running a fund when, tariffs and things can cause the markets to move. The last prepared question, I'll take one or two from the audience, is a great question. How do liberal arts students get into hedge funds? We were talking before, it's an interesting question. I would say a couple of things. To the extent that Harvard does have business school classes, and there are some, obviously, of course there are, they may not get into the weeds with hedge funds, so it's somewhat challenging. So I think there's a couple of things that one can do. First, obviously take some business classes, number one. Number two, to the extent you can find an internship in a great financial firm or great hedge fund or private equity firm in Boston or Cambridge or anywhere. And I know some people are coming to New York this summer. That is certainly a great way of doing it. To the extent that you can do anything else to differentiate yourself and show that you're serious, maybe getting involved with one of the local professional associations, maybe interning at some of their events. Yeah, to the extent that there's a Boston hedge fund group and I can help introduce you to some of these folks, volunteer at an event or two. You'll get to meet a lot of the people in leadership positions. And I can't tell you, how many firms say we don't hire interns, we don't hire people straight out of college, but they meet somebody who's interning at the local hedge fund group or interned at the firm, and surprise, surprise, they're the first person that this firm ever hired, straight out of college or something like that. And obviously, again, I mentioned on the former slide, do a LinkedIn search for people who work in hedge funds, hedge fund or hedge funds in quotes, and university, Harvard, and city, whatever your favorite city is, and then send a nice email to all 1, 2, 3, or 400 of them. We've got not much time, but I'd love to take a question or two if anybody's got anything to do with hedge funds, careers, investors, fundraising, or anything similar. For free. Sure.
Evan, thank you so much for doing this. I was really interested in what you were saying around seeing around corners or folks who are really smart at reading tea leaves without having insider information. I know you work with a bunch of different hedge funds and vastly different strategies. Have you seen anything interesting or novel recently that particularly excites you about people's strategies and models to the extent that you can share?
Yeah, sure. The question was, what interesting, different, unique things are people doing in this space? It's it's pretty incredible. I mean, obviously there's some stuff in artificial intelligence, and I don't want to overstate AI, but one can certainly not overstate how much it's impacting. Obviously it should not be like the dot-com boom where people threw darts at every dot-com company. Not a smart idea, or any other thing. It's what's that old expression? It's never as good when everyone says it's great, and it's never as bad when everyone says it's bad. But obviously there's some AI things that are just incredible. But it really is, where's the world going? What's likely to happen? Is there going to be a war in Iran? Although I don't want to dwell on, a war where many people have died. But were some people who, saw things with COVID. There were people who made millions of dollars by shorting the airline stocks just before people realized how bad COVID was going to be or could be. And, it was probably a great trade, because even if COVID didn't turn out to be that horrible, you're probably not going to lose your shirt. But if COVID does turn out to be horrible, it's again, there are just some people who can manage to do that, or the people who shorted subprime when 99% of people thought that subprime was the greatest thing since sliced bread, or the people who shorted Lehman Brothers and Bear Stearns when everybody else said you should be locked up for being certifiably insane. What was the famous Steve Jobs quote about Apple? The crazy ones or something? Now, that said, if you think the world is flat and everyone says it's round, it probably is round. But at some point in investing, people don't need your hedge fund to, buy the S&P 500. They're not going to pay you 2% and 20% for it, certainly. There comes a point in some time where, just try to figure out what other people are somewhat missing. It's sort of like, the neighborhood that gets gentrified and real estate prices go through the roof. And every person who goes there says, to their friend, themselves, or their significant other, or their family, gee, why didn't we buy real estate here 10 years ago and the prices have tripled? Well, you knew the neighborhood existed. And so, it really is just, it's a lot of, it's a lot of hard work. Maybe it's also kind of like that famous expression at Apple. I think Steve Jobs said it. For every yes, there's 100 no's. But it's just trying to figure out, the old Wayne Gretzky quote, if I had $1 for every time someone said it, where's the puck going, not where's the puck now? And I've not really looked at the whole thing, with the Iran war, but there must be some hedge funds and individuals who made a fortune, by basically, buying oil futures or something else, saying there's a likelihood this is going to happen. So, I guess I'll answer that question. I'll take one or two more briefly with Albert Einstein's famous quote, genius is 1% inspiration and 99% perspiration. So that's probably it. And I'll take one or two more questions, and thanks. Sure.
I recall you mentioned that there's such a hedge fund that's pretty much sports betting. And so now that prediction markets like calcium coin market are popular right now, I'm just curious to hear if you think that there might be a hedge fund that might trade on prediction markets sometime in the near future. And how like regulation.
Yeah, the question is about prediction markets, and I was thinking about that earlier. It is a fascinating space because I'm not an expert on them, and I think that there's a spectrum of things. There's a spectrum on the prediction markets of things that are extremely important and really may change the world, that are somewhat important and really might change the world. And from my knowledge, then there is stuff that is absolutely positively trivial. Things like, I don't know, what color shoes will the person wear who's doing the Super Bowl halftime show? Or something, what will be the first letter of the name of the person who wins the Bachelor or the Bachelorette? I mean, and some of it is just ridiculously inane. But I'll put it this way. I mean, I'm a favor of markets that are efficient and fair. And the question of who's going to regulate them, are they going to be deemed an exchange? I mean, we just went through this with cryptocurrency, where for the last 5 years, it's been anybody's bet, cryptocurrency. Is it a security? Is it not a security? Is it a commodity? I mean, it was just, and a lot of smart people giving 5 or 6 completely different answers and no one really knowing. So the prediction markets are going to be an interesting space. I was going to say, something about the Iran war, though, and a lot of these other things. There's now been a huge push to have a crackdown on insider trading because, it's just opened up all sorts of stuff where you could have a serviceman or servicewoman who happens to mention casually to somebody they're deploying, this is before the war broke out, hey, I'm not going to be around next week for our weekly church meeting or poker game because I'm going off to the Middle East, saying it innocently to a friend or a neighbor who then goes on a prediction market and puts down a wager there's going to be a war in Iraq before the end of such and so date. So, I mean, the insider trading potential is huge. And, for people to, to commit insider trading or anything else, that's one thing I'll mention too, briefly too. And I'll close with this if there's not one more question. But, everybody in this room hopefully will be in a position at some point to make great or bad decisions. Be careful on decisions. They can really change your life. I've often said, to accomplish anything takes a lot of hard work. Meaning, well, just that. Malcolm Gladwell says 10,000 hours to learn how to play tennis or play the violin or learn a new language or something. But be careful out there. What do they say? Success is like the escalator that goes up gradually. Failure is the elevator shaft that it can happen in a moment. So at some point, everyone here is going to be in a situation where, God forbid, they could commit insider trading or just even stupid stuff. I mean, people have lost jobs at major firms because somebody who worked there charged legitimately for their dinner and then ordered 1 or 2 more for their boyfriend, girlfriend, or their roommates or something stupid like that. Just think twice about decisions, people make. I often say Kobe Bryant and John Kennedy Jr. should be alive today. But they made the stupid decision of saying, I've got to get somewhere. And they flew in a plane or a helicopter when the weather was horrible. It wasn't like they were walking down the street and a piano fell on their head from the moving company. And, it's sad, but you have to walk down the street. They both decided they had to get somewhere, went into an airplane and a helicopter when the weather was horrible. So, I would say, you'll be in a position to do a lot of good things in this world, but, just be careful of some of the big mistakes. When someone's drinking and driving, one big mistake can ruin your life. One more question or no?
Good.
All right. Thank you very much, everybody. Appreciate it.